This is Eric Muathe from Muathe.com. In this video, I want to discuss this idea of looking for oversold or overbought stocks, ETFs, futures, instruments, or cryptos. So the idea is you want to find them when they are oversold, which by definition means that they are about to pull back. And if you're looking for, by definition, oversold, the thinking is that if you can find those stocks that have been oversold, then they're due for a bounce. Now, generally speaking, there is a strong misconception here because a lot of the times these filters that are generated by websites and software are looking for RSI above. So RSI above 70 is what they're going to screen for, what they call oversold, and RSI 30, anything below that, they're going to call that to be oversold. Now, there is a strong, generally accepted misconception. This is not correct. In fact, the opposite is very true. Let me give you some examples. Let's take a look here at a stock that trades in the London Stock Exchange. Take a look at this movement here, where it moves above 69.1, which, by the way, is where people tend to call that 70, but it's really, this is the number. And it's my own researched number, but anyway, that's besides the point. You can see if you took that advice and went short this stock at this point, here, you made an epic mistake. If you did the same thing here, you made another epic mistake because it so turned out that this is actually where you want to go long and be bullish. And in fact, we can see that from this entry here in late 2014, the stock stayed above 69.1 throughout this phase here. In doing so, it skyrocketed from, let's call it above, let's call it 80, and held on above 69.1 until somewhere here at 450. So clearly, trying to go against stocks that are moving above 69.1 is absolutely wrong. Let's take a look at another example. All right, let's take a look at the last visit here. So last visit here above 69.1, which is this period here, late 2016. If you went short there, you made another major mistake because take a look at the price action. Not only does it pick up and gain more ground, it actually picks up momentum to the upside. So clearly, trying to go against the market here is another wrong understanding of market dynamics. In fact, when a stock generally moves above 69.1, it is a strong buy at that point. It is the exact opposite of what is taught out there in websites and textbooks. I should have mentioned, this is another London Exchange trading instrument. All right, let's take a look at another example. Now, this one is an Indian stock. Clear example of why you should never go against the 69.1 threshold. If you did so, the stock moved above 69.1 here, and of course we can see what happened. Not only did you gain ground, you picked up very strong momentum, and the stock remained bullish throughout the phase when it was trading above 69.1, which is this very desirable period. In other words, going against the market at that threshold 69.1 is a clear misunderstanding of how instruments trade. And here we are talking a price entry of about, let's call it under 200 before the move all the way to about, let me see here, 1500, while the RSI was above 69.1. Let's take a look at one more. We'll take a look at this period here, jumped above 69.1. If you knew what you were doing, you go along, you buy the instrument, because at that time it meets the minimum requirements for the ultimate Muathe breakout. And while the RSI is above 69.1, you continue holding, which means all this was available to you throughout this bullish phase. So be careful out there when you call things overbought or oversold, because clearly somebody or the market has not been doing its homework when it comes to how to read the RSI. Eric Muathe from Muathe.com. As always, good luck, peace, and blessings. ETFs. Yes, 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 yes.